Okay, good evening. We are going to continue. Let's look at today's revision. Is a continuation of yesterday, but this is a June diet for 2024 on insurance, pension, and risk management. So we have on the slide the correct answers, and we have provided a short explanation for ease of understanding. So let's begin. Okay. So we look at question 1. In the context of life insurance, sum assured refers to what? What do we consider sum assured to be? The correct answer is B, that sum assured refers to the fixed amounts to be paid by insurance company as benefit upon the occurrence of the insured event. So because we know insurance company is a risk transfer mechanism, they have accepted certain risks, a premium has been made to them. So in the context of a event that is being insured, so the insurance company will now pay the fixed amount. So the fixed amount is considered to be paid by the insurance company as benefit when the stated event has occurred. So in the context of life insurance, the sum assured refers to that fixed amount. We'll offer a more detailed explanation to that effect when we look at the explanation we have here, saying that the sum assured is the predetermined amount that the insurer agrees to pay when the insured event occurs, maybe in the instance of death or even at the maturity of the policy. The sum assured represents the insurer's contractual obligation and forms the basis of the insurance benefit. So this is what sum assured means. It is a predetermined amount that the insurer agrees to pay when the insured event occurs, maybe in death or even at maturity of the policy. So the sum assured represents the insurer's contractual agreement, and it does form the basis of the insurance benefit. Second question here talks about liability insurance, saying that liability insurance primarily covers one of the following. What a cover is D, that states legal liability to pay compensation and costs awarded against the insured in favor of a third party. Liability insurance is what we have in this our vehicle third party insurance, even though we don't do it very well here in Nigeria. So liability insurance primarily covers the legal liability to pay compensation and cost awarded against the insured in favor of another party. So liability insurance do not signify legal fee incurred by the insured in case of a liability claim. No, it doesn't cover for death or injury or even disease or loss. So one thing you will have in mind is that liability insurance is in favor of another party. Number one say is the compensation and cost awarded to the insured for damages sustained by. No, this is just the opposite. No, the answer is D. So liability insurance protect the insured against legal obligation arising from injury or maybe death or property damage caused to a third party. So the insurer in this instance pays compensation and legal costs for which the insured is legally liable. The insurer comes to stand in for you and pay because you are legally liable. So you don't have to worry yourself or try to borrow money, or no, insurance have your backing, you know. So liability insurance pays compensation or cost awarded against the insured in favor of another party. That is what it does for you. It speaks on your behalf, you know, and settle matters on your behalf. So the fourth question here asks us that an insured filed a fraudulent claim to make profit from the purchase of an insurance policy. From the insurer's viewpoint, the tendency to pay the claim without dictating the fraud is represented by what? You know, we have mentioned this before in yesterday's discussion, moral hazard, you know, and we did explain yesterday that it refers to the deliberate dishonest or fraudulent behavior of an insured person who intentionally increases the probability or severity of loss for personal gain. And also, this moral hazard also can come in a way that is not fraudulent, but that carelessness, like I did mention, because you are covered, insurance covers you in a theft prone zone, you park your car, you didn't even wind the glasses, you are consciously or consciously reckless or careless, and your car is stolen just because you know insurance covers you, you know. So that can be considered as moral hazard also, or in the instance of the case, in the instance of the question being asked here, you know, saying the insured filed a fraudulent claim to make profit from the purchase of insurance, maybe claiming your car is missing, you know, because you know insurance covers you. We call it a moral hazard, you know. We can go to illustrate example with moral hazard, having defined it or refer it to be the deliberate dishonest or fraudulent behavior of an insured person who intentionally increases the probability or severity of loss for personal reason or gain. An example, we are saying that an insured deliberately exaggerate a claim amount just simply to receive more compensation than the actual loss suffered. So we say that is also a moral hazard. Like I said before, even yesterday, we made this moral hazard in a yesterday discussion. It could also be the unintentional carelessness or negligence with reference to your property that was insured and it happens to be vandalized or is missing, just for the fact insurance covers you. So, in as much as you have insurance, you have to avoid moral hazard and apply due diligence or some carefulness with regards to that which is insured and under your care. So insurance covering you does not imply you have to be reckless or behave the way you like just because someone has to come in on your behalf. So the fourth question here, we're looking at the enterprise risk management, ERM, enterprise risk management. You know, appears profitable to modern day organizations than the traditional risk management, TRM. Why? The answer is simply because the traditional risk management focuses primarily on risk within specific department or function. You know, it is it's not a long range. It's confined to department or function. While the enterprise risk management addresses a risk across the entire organization. We discussed this in the class. You know, so this is key that of enterprise risk management is more strategic and even have board members in a discussion in the class. You know, it's more strategic, is organizational wide, but traditional risk management sometimes departmental wide or unit, you know, is confined. So that is the answer. Answer is B. And our short explanation further says that the enterprise risk management adopt a holistic and integrated approach to risk management by considering strategic, operational, financial, and compliance risks across the entire organization. So, but the traditional risk management often operate in silos with departments managing its risk independently. So we elucidate this during our class discussion. So we go on to look at the next question. which we have there. The next question talks about a ship covered by marine hull insurance policy has collided with another vessel. How will the policy apply in this situation? So, how will the policy apply in this situation? So, how the policy apply is what we are going to consider. You know. So again, the question says a ship covered by the marine hull insurance policy has collided with another vessel. How would the policy apply in this situation? So it will cover the repair costs for physical damage to the ship, machinery, and equipment. So it's physical damage because the content of the ship, ship is a means of transportation. You cannot say it carries this on Monday and carry this on Tuesday, or carry this on Wednesday or in February and that in March. So the content of the ship is not insured. It is the ship entire is insured. So the damage done to the ship, the physical damage to the ship or the machinery or the equipment as it is will be considered. But other damages by virtue of maybe life or maybe goods and all that is not considered, because at the point of insurance or event that was considered did not include those items. Of course, we wouldn't know what the item will be. So what we did is to insure the ship, and this collision that have happened, we have to repair and restore the ship to its former status. Okay. So A wouldn't be the answer. A say it will compensate for loss of income suffered by the ship owner. No, it won't fly. It will compensate for the value of the no, it won't fly. It will cover medical. No, it will not. It is the ship that is insured, you know, is a ship that will insure. In terms of medical expenses, if the individual or passenger or those in the ship, have their own insurance that covers them. So that insurance will handle those for maybe life insurance, as the case may be, health insurance, as the case may be. But in the instance of the question being asked about the damage on the ship, it is the ship that will be repaired. So repair cost for the physical damage of the ship is what will be considered. Other things will not be considered. So a further explanation we have here highlights the same we have just discussed, saying that the whole marine hull insurance covers physical damage to the vessel itself, including the machinery and the equipment, all that concerns the vessel or the compartment or the complementary things that has to do with the vessel as a whole. So cargo losses are not covered under marine cargo insurance, so that is that. The next question, we look at risks. We are saying risks that are capable of financial measurement are often insurable, are referred to what? Often insurable. We had this in one of the yesterday's discussion, but there is, if you remember, that was a environment pure risk we discussed there yesterday. But here the answer is financial risk, because the question is different. So financial risks are capable, you see financial measurement and are often insurable. So like I said before, in answering question, also read the question very well. Sometimes the answer is premeditated. Is the answer is in the question. Sometimes how the question is being asked will give you insight of what the answer is. In this instance, we are looking about financial measurement are often insurable and are referred to. When you talk about financial management, you will not leave financial risk and start talking about pure risk or speculative risk. Of course, you go to financial risk. So the answer for this is financial risk is A, because financial risk can be measured in monetary terms and therefore can usually be insured also. Since insurance simply aim to compensate financial losses, the loss must be capable of valuation. Yes, it must be capable of valuation. An example could be property damage, theft, and fire losses can be quantified financially. We often see where there's arson, a fire burned down, say about 50 billion destroyed, or a case may be. You can quantify that. Okay, so financial risk can be measured in monetary terms, and therefore it can also or usually be insured. Yes, since insurance aims to compensate financial losses. So the loss must be capable of valuation, you know. So let's look at the next question. An ABC insurance obtain a stop loss reinsurance with a threshold of 1 million. So during the year, cumulative loss was 800,000. How would the stop loss reinsurance apply? How will it apply? So it's good to understand it. First of all, the stop loss reinsurance only by effective becomes effective when losses exceed the agreed threshold. So it says stop loss. The language says stop loss. It only becomes effective when losses exceed the agreed threshold. Since the loss is 800,000, it's below 1 million. So the insurer bears the entire loss, you know. So here we are saying that stop loss insurance only apply when the loss that have taken place is above what insured. They will not take over. You know, I happen to say this, I love Mercedes car. I don't know, I'll go and do the stop loss insurance. And the car, I bought it at 5 million. I said, I don't want anything. Let me insure it at 5,200,000. Whatever happens, you know, this stop loss insurance will now give me a new one. You know, I love Mercedes Benz. And after within the year, the car was not stolen, but somehow something happened that it was destroyed or damage on the car happens to be cumulatively. All is about 4,900,000. So what happens here is that you will go and look for 4,900,000. Your 5,100,000 insurance for Mercedes will not apply. You go and repair your car and continue moving. But assuming the car shattered entirely, no way to repair it again, and that car in the market at that time after the 8th or 10th month, that car is considered as 7 million, you know. So it have now exceeded, you know, it has now exceeded, and they'll give you a new one because you insured at 1,200,000 and the damage is about 7 million. So you get 7 million worth and you'll be happy. But when you have insured for 5,200,000, the damage is cumulatively at 4 million. The insurance will not answer you. You just go and look for 4 million and repair your car, you know. So that is what or how the stop loss reinsurance apply. So in our question here, the ABC insurance obtained a stop loss reinsurance with a threshold, you know, a benchmark of 1 million. So during the year, something happened, cumulative loss was 800,000. How would the stop loss reinsurance apply? How it will apply is B. The ABC insurance will retain the entire loss as it is below the specified threshold. That is the answer. Sorry, ABC, sorry, you repair. Okay, the next we are looking is 8. Which of the following option best explains social insurance? We have come across this in yesterday's discussion. Social insurance, you know. What applies here regarding social insurance is that it is a public insurance scheme sponsored and managed by government. We have many of them. IATF, there are so many. There are so many. Even National Pension Program is also a social insurance scheme. Social Security Scheme, even Employee Compensation Scheme, they're all social insurance. But it's good to understand what is social insurance first, so it will give you an insight to answer the question. Social insurance is established by government to provide social protection against risks, such as maybe unemployment, disability, old age, sickness, and the workplace injuries. So that is what is established for and stand for. And they include, for example, the National Pension Program we key into, the Social Security Scheme and Employee Compensation Scheme. So back to the question is say which of the following option best explains social insurance? A, say it focuses on increasing consumption. No, not only that, this should be reducing it. Not only that, even where you are not retiring, you know, it's a private insurance scheme managed by no, that is not so. D say it is solely sponsored and managed by no, not so. Sometimes it's not only by employer. So the answer is C, that it is a public insurance scheme that is sponsored and managed by government. I'll explain what is social insurance. Let us reiterate again. Social insurance is established by government to provide social protection against risks such as unemployment, disability, or old age related issues, sickness, and workplace injury. Example of such social insurance scheme we have highlighted is our National Pension Program, Social Security Scheme, and the Employee Compensation Scheme. Okay, let's navigate downwards. Number 9, negative employer ratings can deter potential employee from wanting to work in an organization. This anomaly can best be corrected by investing more in what? Of course, is C, investing in reputation and branding. Reputation and branding. Your workplace don't have a good name, or where you intended to go and work doesn't have a good name. You have to rebrand or show reputation. Imagine you are going for interview, you inform a friend, QDS called me for interview. And your friend said, wait, QDS, the one in Lagos? Yes, nah. Suicide, suicide. You say, what do you mean? He said, well, my sister, I don't want to go and die. It has poisoned your mind. And I started explaining to you what happened. My uncle worked there, this and this worked there, No. You say, I won't go. Thank God you told me. I will not. The person will not go for the interview because of the reputation. So when they have such negative things, when the question have just shown us, the question say negative employer rating. The company, the employer is rated negatively. And that also is affecting potential employee like you, whom your sister have told suicide. You will not change your mind in working in the industry. So how will the organization try to correct that? So they will quietly, they will try to see how they correct that by investing in a reputation and branding. That's what we'll just say. So employer reputation and employer branding will now influences how prospective employee perceive the organization. A strong employer brand thus attract quality talent and improve recruitment outcome and also enhances employee retention. So let's look at the next question. Which of the following qualifies an individual to operate as an insurance agent in Nigeria? Certificate of proficiency issued by Charter Insurance is no. Certificate of registration issued, no. First degree in no. License of operation, yes, not certificate. Even though you ought to have those certificates, but the operation, the permit is license. License is very key. So many things permit has to do with license. You can drive a car. I drive my father's car, yes, but you need license to certify that you can drive or you can apply drive a Nigerian road. So the answer is license of operation from the National Insurance Commission. Then a further explanation to highlight why that is correct, we say that under Nigerian insurance regulations, an individual must obtain a license that is issued by the National Insurance Commission before legally operating as an insurance agent. Academic qualification and a PhD holder in insurance do not authorize practice without regulatory approval. Even itself, that's what CIPM is trying to do, already doing. That we have so many quack human resource professional or practitioner. It's not being abusive is a term. Quack is someone who is not licensed to do a thing, that is not certified to say, yes, we will vouch for you. It's called quack. We have the quack nurses, those who are still on training, they're not yet licensed. We have quack teachers, those who have not done what is it called again in NCE, PGDE education. They are quack, So regulatory body they fight against quack practitioner. So if you are licensed, you will no longer be a quack because the regulatory body will append their seal on your certificate that says we know him, allow him to practice human resources, allow him, we know him. So that is it. License of operation from National Insurance Commission is the answer. D, regarding the question that is being asked here, question which says, which of the following qualifies an individual to operate as an insurance agent in Nigeria, is license of operation for the National Insurance Commission. So risk dash is a process of determining the premium to be charged on policy based on the class of insurance. Is rating is the answer. Rating is not acceptance, it's not assessment or selection, it's rating, risk rating. You rate the risk. Don't you see this, so that you can be able to now present your charge, which is called premium, your fee, which is premium on the policy based on the classification of the insurance. So risk rating is that process of determining the premium to be charged, you know. So further explanation of risk rating, we are saying that risk rating is a process of determining the premium payable by an insured based on the level of risk that is involved. So the insurer classifies risk and assign appropriate premium rates to ensure that premiums are adequate to cover expected losses and expenses. Also, premium is also equitable. It should be equitable as well. So that is the risk rating and what it does. We have just explained. So in terms of premium and losses, proportional reinsurance works in one of the following ways. The reinsurer want to know how proportional reinsurance works. The reinsurer share a portion of premium and bear prorated share of losses. That's how it works. Reinsurance works in a proportionate share of premium and bears a prorated share of losses. So we share in the premium proportionally and also share in the losses when they occur in a prorated share manner. So by further explanation, we are saying upon proportional reinsurance, both the reinsurer and the insurer, they share premium, yes. Premium is that we discussed that in class that I'm going to insure the NNPC building, or I'm going to insure Transcorp heating, as it's called. I want to insure it. So, but the money they gave me premium is so high. I said, nah, let me not get into trouble when this thing happen to be burned down. Let me look for someone else also and bring him as a reinsurer of the same Transcorp. So now, depending on what I'm reinsuring, the person will now evaluate it, and it also has a premium, such that when something happens, he or she will bring part of the repayment model or for claim, time for claim. You have to bring something also, time for losses. You have to bring prorated share of the losses. Prorated is that the principal person will take more. Maybe it is 60-40. The premium is in that same manner also. So when there is a loss and there will be a claim, the person will bring 40 while I'll bring 60, so that we reinstate the Transcorp heating to its original form before they break down. That's what that one is saying, So that is it. We'll have an example here, So let's continue. I hope that is understood. So which of the following best describe the pay-as-you-go method of funding a pension scheme? Which best describe that? We have taken number one, saying the employee pay pension from the organizational current income when benefit first due. That's what happened. You pay the pension from the organizational current income. So to explain that, the pay-as-you-go funding a pension is that the employer will pay from the original current income when benefit is due. To explain that pay-as-you-go further, we are saying that the system, the pension benefit are paid from current revenues rather than from previous accumulated pension fund. The system was common in many public sector pension arrangements before the contributory pension scheme became popular. The one we are doing now, the 18%, 10% employer and 8% employee. So before this contributory became popular, the pay as you go, this is the way it is being funded. Okay. So let's look at what strategy should an organization adopt to protect its valuable data assets, reduce data breaches, ensure compliance, and maintain stakeholder trust. What strategy an organization should adopt. So looking at the option in this data-driven environment, business environment, is the answer here, or the best of option is data and information risk management. So the strategy organization should adopt in order to secure or protect its valuable data assets by way of reducing data breaches or ensuring compliance, or also maintaining stakeholders' trust, is by way of data and information risk management. That is the answer. Data and information risk management that focuses on data protection, cyber security, privacy, compliance, prevention and unauthorized access or limited access, and business continuity. It helps organizations safeguard critical information assets. So that is the answer. The answer is data and information risk management is a strategy that should be adopted in order to protect valuable data assets of any organization by reducing data breaches, also ensuring compliance and maintaining stakeholder trust. That's what happens there. Okay, let's look at this question. It says, Section dash of the Life Assurance Act of 1774 provides that the life insurance policy should contain the name of the person interested in it. Which section is that? The answer is Section 2. Section 2 of the Life Insurance Act of 1774. Please try to get it. 1774, Section 2 of the Life Insurance Act. Talking about Section 2. So Section 2 of the Life Insurance Act of 1774 requires the policy to identify the person who has an insurable interest in the life insured, because this provision was then introduced to prevent wagering contracts disguised as insurance. So that's why it was done, to prevent that. So the term fire and special peril policy refers to an insurance policy that covers what? It refers to insurance policy that covers additional peril beyond the standard fire coverage. So when you hear the term fire and special peril policy, your mind should quickly go that it refers to an insurance policy that covers additional peril beyond the standard fire coverage. A fire and special peril policy extends beyond basic fire insurance to include additional risks such as flood, explosion, storm, aircraft damage, riot, and strike. Hence the term special peril. So that is it. So we stop here and continue from the next question. Stop here and we'll continue on next question. So the 17 says, what distinguishes treaty from facultative reinsurance? What distinguishes? What's the difference? Treaty reinsurance covers every risk of a particular class. Every risk is covered, while facultative reinsurance is usually arranged for individual or higher value risks. So facultative, is arranged for individual or higher valued risks. But treaty reinsurance is every risk is under that. So having said that, we may wish to stop here. I don't know if you have question, you can drop on the chat. I've just written something on the chat. I need your reply. Okay, so drop your question. What do you have as questions so we can respond to that immediately on the chat? Okay, it seems you don't have question. So we call it a day. Thank you for your attention. We're going to continue probably the next time tomorrow from this. Continue from this. Thank you for joining. You can go back again after the lecture or at your own spare time to go through them again. Go to them. Thank you very much.